Our next guest says now's the time for the Fed to stop raising rates, calling on the central bank to reevaluate its 2% inflation target. Joining us here at Post 9, Marc Morial, president and CEO of the National Urban League and former mayor of New Orleans. Marc, thanks for being here.
Hey, thanks for having me. Good to see both of you.
So you're saying, this jobs report is basically the end of the line. No more rate hikes from here. It's showing the slowdown that the Fed has been trying to engineer, and basically their work is done.
It's important to understand the Fed's dual mandate. One, price stability. Two, full employment. And I think inflation is now easing. I think while we've had consistent job growth, now job growth seems to be easing a bit. What the Fed cannot do is make unemployment the weapon in fighting inflation. And so they've done a good job navigating thus far. I say hold on the rate increases, and you can resume it if you need be, because the high interest rates are now beginning to affect the housing market, could begin to affect business investment and therefore job creation. So I think it's time for them to sort of hold off with any more rate increases. And secondly, I think it's also time for them to reevaluate, Carl, whether the 2% benchmark is the right benchmark for today's economy. That's an old benchmark, probably envisioned in the 20th century. The economy is much more dynamic. We have technology, we have globalization, we have supply chain effects. It's time to reevaluate what's the best, if you will, benchmark inflation rate for the Fed.
We've been kicking that around for a while now, and the answer is always what would happen to the dollar, what happens to the Fed's credibility. You'd have to be gentle, right?
You'd have to be careful, but it's time to evaluate it. It's time for there to be a discussion about that, because the economy's changed. For a long time, when we had low inflation, we also had wage stagnation. And, of course, wages and, therefore, consumer spending drive the economy. And, therefore, as we've seen this inflation, one important thing is the increase in wages across the board. A little wage inflation that's consistent with price inflation means that workers can keep up with the changes in the economy. So I think that ratio is really as important as basically what the inflation rate is on an overall basis. So I think it's time to reevaluate it. The Fed, I give the Fed credit thus far for navigating and balancing.
After a couple early stumbles?
Yeah, absolutely. So now let's not, I think, continue to raise rates and risk slowing the economy and raising the unemployment rate or slowing down job creation. You can return to that if you need be.
But are you of the mindset that they need to be cutting from here? I mean, have things degraded to the point where it would make sense to be turning dovish again?
I think it's time to hold. And cuts can come in the future if needed and necessary. But they've been very aggressive. We haven't seen spikes in unemployment. We now see a little bit of an easing in job creation. So I just feel that the Fed's dual mandate, everyone needs to understand they've got a dual mandate. Full employment on one hand, price stability on the other. You've done an admirable job so far. Now, let's not create a scenario where they're going to be, if you will, whiplashed into rate cuts in order to re-stimulate the economy.